Hello.
Hey guys. Hello.
Hey guys. Uh Good morning, good afternoon, good evening. Welcome everybody to CoinGecko's 28th virtual meetup. The title of our meetup today is the RWA or Real World Asset Roundup. My name is Zhong. I'm the head of research here at CoinGecko, and I'll be your host for today. Joining us today to talk about RWAs, which is really a hot topic in crypto right now. We have Sid Powell, who's the CEO and co-founder of Maple Finance, and we have Eugene Ng. He's the co-founder of OpenEden and DWF. We're supposed to have Cassidy Daly as well, who's the co-founder from Centrifuge, joining us. Maybe she'll jump in a bit later. We couldn't seem to get her, but yeah, I think let's sort of get started. I think and let's see if she catches up. Yeah. So I think really, RWAs or real assets, it's definitely a hot topic now in crypto, but it was certainly not new, right? Where we've seen iterations of this throughout the years. I think starting with things like simple gold backed tokens, and then now it's sort of evolved into all sorts of things that's being offered by our panelist projects here, from tokenized T-bills from OpenEden, as well as the private credit stuff from Maple Finance. So a lot of a lot of new renewed interests, and a lot of significant attention in 2023. I think my first question to both of you, Sid and Eugene, is like, why do you think that's the case? Like, right? Why has there been this explosion of interest and explosion of hype and surrounding RWAs this year? So maybe Sid can go first. Yeah.
Yeah, sure. And I can see Cassie's joined us as well.
Oh, hi
Um,
Cassidy. Yeah, thanks for joining us. Yeah, great. We just got started, so yeah.
yeah, so I think I chalk it up to a couple things. So the first is opportunity cost. So I think in terms of in terms of if you profile the alternatives that people had last year or the year before, there was a really high degree of interest in yield farming, and there was a lot more volatility. So there were a lot more other options that have now disappeared in terms of where you park your money. And then the other thing is the pickup in treasury rates. So we went, from zero in 2021 to now 5.5% at the moment. And if you pair that with people's risk off attitude to where they deploy capital now, it's kind of like those three factors have created this interesting confluence where now everybody wants to park their funds in T-bills. And I'd note that's probably the dominant form of real world asset that we're seeing on chain at the moment, is to the tune of hundreds of millions versus substantially less forming in private credit at the moment.
Yeah. And Eugene?
Yeah, for me, it's similar to Sid, right? I mean, the macro environment is such that effective Fed fund rates today it's 5.33%. It's sort of a no-brainer to have your money, sitting in risk-free rate at 5.33%. Global money markets, are enjoying a boom this year, right? Effectively trillions of dollars are flowing to money markets. I think one of the primary reason I would say would be the loss of trust with centralized institutions, DeFi protocols across crypto, right? With the onslaught of the credit explosion in the last 18 months, and I think that really resulted in something that the market wants something that is safe, that they understand and is sustainable. I think the second thing would be the maturity of the DeFi infrastructure today, this year, the emergence of layer two. I mean, without layer twos and the scaling abilities, I think it's going to be very challenging for many consumers today to access, real world assets on chain. And I think the third factor would be DeFi risk-free rate, which I think, Sid has alluded, the fact that risk-free rate, off chain in US Treasury bills is higher than DeFi risk-free rate, then clearly, there is that incentive for people to pursue U.S. Treasuries. So I think clearly those three factors resulted in that push towards RWA this year.
Yeah, and Cassidy, I think the question, I'm not sure if you missed it, was like, why do you think there's been an explosion in interest in RWA this year? Yeah.
I mean, just to echo what these guys have said already, DeFi yields are lower than, these traditional yields in public credit, private credit. So obviously, if you have your money in crypto, you can't get yields through all of those ways that you could in DeFi in the last couple of years. Basically, since the bear market started, it just didn't make sense to, use those DeFi protocols in those same ways anymore. Just trading on crypto native assets, right? And so that's where real world assets, I think, become much more interesting. The issue with the only parking your money in T-bills and only looking for the risk-free rate is that that rate really mirrors inflation, right? And so if you want to be able to actually get something more than just keeping up with your money, you actually have to look for yields that are higher than the risk-free rate. And obviously that comes with risk, but that is where private credit sits, is going the next step from T-bills is, I think, where we're going to see crypto assets, crypto liquidity go in the next step. And obviously that's where a lot of interest is going to start focusing.
Yeah, I think for centrifuge, it's been close to 2 years since centrifuge first launched the RWA market with Aave, right? I think all the way back in 2021. Talk to us a bit about Cassidy, the motivation for building an RWA product back then, and how do you think between 2021 to now 2023, we're getting to the end of 2023 now, how things have changed, and have the investors changed? Have the people coming to market for credit changed? What has much changed in the last 2 years?
I would say, yeah, definitely a lot has changed for sure. So we built this real world asset market for Aave 2 years ago, but we actually already launched. We've been building Centrifuge for the last 5 years already. I think we've learned quite a lot in that time. This real world asset market on Aave was specifically targeted at being able to have more of DeFi retail users be able to use real world asset protocols like Centrifuge. And Aave already had quite a lot of a user base there. And so the idea with this market was be able to open up Centrifuge even more to this audience. I think what we learned from that was actually that there still isn't a lot of retail interest for real world assets. I think we're still getting there, and I think we'll start to see more products focusing on the retail users. But one thing we really learned from that experience is that most of the users that are interested in real world assets right now are still larger institutions or DAOs. And so that's why we launched Centrifuge Prime as our latest product that's really focused on the DAO user, which is a larger user that's a little bit more educated, because it is really complex to understand real world assets. And it does take a lot more due diligence into what's actually underlying all of these assets. And so I think that's why we've seen the users that are more interested in using these products tend to be a little bit more educated, have larger teams, and a bit more ability to really dive in and understand what these are.
Okay. Yeah, I think we're gonna talk about DAOs a bit, because there's already audience questions coming in asking about those things. So I wanted to hold that thought for now. But coming to Eugene, I think with OpenEden and with T-bills, I think they've really become the rage, like Sid said at the start. In TradFi, US Treasury bills are typically favored by institutions. I think this year it's favored by everybody. It really has saw an explosion as saw the rates went up, and there's now an audience on chain, right? Clearly, that's why you guys have rolled out a product, and other people have also rolled out similar products as well. I guess my question is why, and you've talked a bit about that as well. But the follow-on question really is like, who are the clients and who are the parties, I guess, on chain that's most interested in this T-bills, on chain T-bills.
Yeah, I think there's some of these points that we talk about And I would like to say that I think one of the major reasons as well would be the Operation Choke Point 2.0, where a lot of crypto-friendly banks and institutions were being asked to close. I think that created a very high barriers to entry for many crypto native companies to access, cash management like products. And that's frustrating, for this, 130 billion-dollar stablecoin market where they're trying to chase for something safe. I think the second reason would be, I think not all stablecoins are made the same, and clearly, in the last 18 months, there were a lot of stablecoin implosion. I think that has resulted in re-examining the risks around stablecoin, and I think with that, it also drives a lot of flows from stablecoin, either stablecoin to productive asset like T-bills on chain. So I think that's really the second driver, and I think the one point I want to make is, yeah, T-bills are generally favored by institutions, but at OpenEden we effectively pull very short dated T-bills, so it's really like a money market fund, and money market fund has discriminates no balance sheet or no institutions, in the sense that whether you're a startup company to the largest institutions, Web 2, Web 3, I think it's imperative to engage in sound cash management practices. And I think that's also the reason why it's been very popular, given that interest rate is on the rise. And so who are the audience, right? So we have four types of clients. I think number one, DAOs. I think Cassidy has just mentioned. I think obviously DAOs is a very interesting set of segment that clearly have a lot of balance sheet, and on top of real world assets. I think the added value is the transparency. So, if a DAO invests in off-chain assets, there's a lot of opacity, right? Like you don't even know what the DAO is doing. But if you have actually tokenized your assets, you can actually go on the ledger and check, right? So I think that's one. Second, I think stablecoin issues where we're realizing that using real world assets on chain is going to really aid in transparency, and especially given the success of MakerDAO, I think it's sort of moving towards that direction with more stablecoins implementing or at least divesting into real world assets on chain. The third category, which is really interesting, we actually built the solution for a lot of startup companies, DAOs, and stablecoin issuers, but clearly liquid VC funds, we are starting to see an emergence of this segment. And given that OpenEden has built a tokenized vault where you can literally buy and sell T-bills 24/7 on chain outside the US trading hours for instant minting, that really allows a lot of liquid VC funds to get in, get out very quickly, even faster than TradFi rails, which I think is super important. So we do see a lot of demand from liquid VC funds. And then lastly, obviously, clearly, crypto startup companies where, in a bear market like this, back in the bull market, nobody cares about cash management because you can literally, raise more money, you can sell your tokens. But it's a bear market, it's tough, every dollar counts. So this has been a very clear segment of customers.
Nice. I think I think we've heard a lot about T-bills and all that, and yeah, like you said, it seems to have appeal across a wide spectrum of investors now. I wanted to come back to Centrifuge and Maple. So if we think about credit as sort of there's the public side and the private side, and obviously the public side is represented by treasury bills and as well as government bonds, and on the private side, which is what Centrifuge and Maple are working on, it's loans to businesses and things like that. Obviously, you guys have been around for a while. There's been a lot of twists and turns, right? On this journey, there's big questions always, I think, around credit assessment, defaults. How issuers or borrowers are sort of onboarded onto the platform, and how repayment is being monitored. I guess having been on this path for a while now, What are some of the lessons learned? And I know you guys have sort of continuously iterated and improved on your methods as well. Maybe Sid can start first, and then Cassidy can also jump in after.
Yeah, sure. So I think one of the key things that's important is diversity of opportunities in private credit. So I don't think you want to have one or a small number. I think you want to have multiple different options, because there's going to be different lender or investor preferences. And then I think so that's one element. And then I think the other one that's really important is adverse selection. So we get and I'm sure Centrifuge does as well, a ton of inbound interest from folks who can't borrow money elsewhere. But typically it's not because they're at the cutting edge of innovation. It's just because they're not as creditworthy. And so there's a huge filtering task where it's like maybe 1 in 10, 1 in 20 should go through to like kind of the next stage of evaluation. We've mostly focused now. So we have one pool doing private credit, which does tax credit factoring. US-based assets. It's high yield, so it's it's paying 14% net of all fees, and it's short duration, so it's 6 month or shorter return of capital profile, and that's kind of ultimately what we're looking for now as we look for the next assets. It's not, we don't want to take, people don't want to take emerging market risk. They don't want to do real estate for a 2-year lockup, so it's going to be short duration. And they don't want to do high quality assets for 9%. So the pockets of capital that you have to go after need 10, 12, 13% net yields on the assets. And so we're finding that I think that probably most likely appears in trade finance, accounts receivable, supply chain finance, but it's going to be the shorter dated stuff. Real estate, I think, has been a bit of a red herring that a lot of folks have gone after, and I think it's probably going to be one of the last asset classes to come on chain, just because of the duration and the lower yield on it. It's already relatively efficient in TradFi anyway. But yeah, so I'd say those are some of the lessons in terms of monitoring. I think a lot of talk is about oracles. I don't know that I think you can do sort of manual monitoring, but the more information you can share with your stakeholders on chain, the better. So for example, on Maple's T-bill pool, we show the QSIPs of the underlying T-bills on the web app, and so I think that direct feed of information about the underlying assets is really important for monitoring, and so I think that's probably what lenders want to see more of, is like real-time monitoring of the off-chain assets for RWAs to really take off, particularly private credit ones.
And Cassidy, what about on the Centrifuge side?
I think maybe I would start with the fact that there are always going to be defaults in private credit, and it's really just about how we price the credit in the first place. And I think Sid mentioned a lot of that, like the assessment of the credit here, oracles also being a part of that, is really important. And so I think on the Centrifuge side, that's why we started the credit group within our DAO, is a group of credit experts who are actually, as you said, Sid, that filter there. That's being able to assess all of the opportunities that are coming in and do deep diligence on, exactly what's coming on to Centrifuge, the protocol, and being part of this process that we've developed to actually onboard new pools and be able to have a really rigorous assessment of what all of those underlying assets are like. So I think that's one, learning that we've had and element that we've added to the protocol. And I think on the other side of things is also, unfortunately, with real-world assets, we really have to think about the legal aspect of these things. And that's important when there is something that goes wrong, when an asset does default, and you have this, worst case scenario where you actually have to do a wind down, for example. And I think this is also something that we've innovated, is actually working quite a lot with Maker on a legal setup that makes sense for DAOs, and specifically being able to allow any type of user, including a DAO user, to be able to take possession of these assets and in that worst case scenario, and be able to recover as much as possible. That said, I would say that across the board in real-world asset protocols, I don't think we've seen an insane amount of defaults. I mean, I think in some cases it definitely didn't feel great. But at least in the Centrifuge case, our defaults are definitely in line with traditional, credit entities out there. So I think, it doesn't, bear markets never feel really good in that scenario. But it is something that we should expect. And I think as we expect these defaults to happen, it allows us to create processes that allow us to have, the best case scenario when something does go wrong.
Yeah, and I think since we touched a bit about on that about expectations, especially when it comes to private credit, there was a question later that I planned for, but I think it's a good time to discuss as well. Is we also touched about this, which is like RWAs are sort of targeted at institutions or sophisticated more sophisticated investors and or DAOs, right, that have teams that know how to assess traditional risk reward ratios. They know what a risk-free rate is. They know what a risk-adjusted return is. Say compared to your typical, I guess, crypto trader or investor. And it's complicated, right? Every I would imagine every case on Maple or on Centrifuge is sort of different, and you need somebody who really can get into the weeds and sort of understand every piece of credit on its own merits. I just wonder, is this in you guys' opinion sort of like a barrier to entry for investors to sort of come in to pick up some of these assets? What has your experience been? Is there sort of an education or a learning curve for people to sort of understand this better?
I think there's definitely a bit of a learning curve, but I would say a lot of the education is still, if you go and talk to a traditional finance investor, you're educating them on stable coins and blockchain and wallets and smart contract risk. For some of the like on-chain investors, you probably talk to them a bit about risk management and the underlying assets. But the way the traditional structure works is in TradFi is a lot of the big investors in private credit. It's a pension fund who's investing in a credit fund who's then doing due diligence on deals. So you just need that one person or that one layer that does the individual diligence on the deals and can then transparently report its performance. And Ares and Apollo have to report their performance to the large pension funds. The pension fund isn't necessarily due diligencing all the deals or doesn't necessarily have a super sophisticated understanding. Like they understand how to measure performance, what the incentives are, and overall how the asset class works, but they don't necessarily need to be in on the weeds. And that's just a function of the way that the value chain in investing and private credit is kind of separated out. I see a future where protocols like Centrifuge and like Maple are going direct to pension funds and kind of skipping around the credit funds like the Ares and Apollos of the world. I think they're kind of they end up being a bit of an unnecessary part of the value chain if they don't sort of get up to speed and start operating on chain, because then otherwise you're just introducing another layer of fees that is not really necessary. When I think one of the core advantages that I am excited about that platforms like Maple and Centrifuge can do, and OpenEden, if they ever went in the direction of private credit, is the ability to transparently report performance in real time, and also have lower operating costs when it comes to managing a book of private credit lending. I think we have a distinct cost advantage in the same way that e-commerce did over brick and mortar stores versus traditional credit funds. And I think over time, we'll just go direct to pension funds and endowments and try and pick up those mandates. I don't know why they would need to then go to an Ares or an Apollo to then put money into a protocol with some other credit manager or underwriter. Like I think the arrow of technology is often in the direction of direct distribution. I think this is going to be no different for financial products.
Yeah, and Cassidy, anything to add to that?
Yeah. I think for us, it's also just important that it is available to any user to access. So I think, the only way that we're able to go in this direction of direct distribution is that we're actually able to do it that way, that, we make it possible that anyone can actually invest in these assets. And I think even if, the average retail user decides that it is too complex and they decide that they would rather go through some active manager in between, it is something that I guess in the ethos of crypto, the belief is really that, that should be a choice of the user and they should still be able to actually access these products if they wanted to do that. And so I think, yeah, building our protocols, I think all of us have really gone in that direction of making it as open as possible to begin with. And then, of course, depending on the asset class, if it is more complex, being able to have options to then pursue an active manager or put it into some sort of other fund who then invest in these protocols. But yeah, making that ultimately the decision on the part of the user.
I think one other thing to note is, like, I suspect that with AI, everyone will probably end up having, like effectively a robo advisor of their own that charges them, 10 or 15 basis points or something, rather than paying an active manager 20% of alpha to, or 20% above of whatever they make above a hurdle rate to get in and select these things. So I think you'll effectively have kind of call it automatic allocations on chain for individuals rather than paying like a person to choose those credits on their behalf.
Yeah, and coming to Eugene, I mean, like maybe you have a opposite problem. I guess T-bills are pretty well known, but do maybe people ask a lot about the structure and how you're able to do this and the fractionalization? Do you get questions like that from users?
Yeah, I mean, the devil's in the details, and I think well, there is a lot of, I guess that there are quite a number of firms today, including Sid from Maple. I think there are different products of different tokenized T-bill products out there, and I think similar to the existing traditional money market sector, there are a variety of money market funds and products out there. So I think there is a lot of underlying legal structuring that I'm pretty sure everyone has their own way of structuring that, and that could be complex. Depending on the approach that one take. It could be some would have structured that relationship between the user, the investor, and the issuer as a lending relationship. There are others that were structured it as a fund where invest as LP. So there are a variety of ways from a contractual standpoint where investors face the issuer. And I think while the product on the surface may come across simple, I think a caution or advice would, for as with all investment decisions, whether it's in Web3 or Web2, understanding the contractual relationship and the structure of the product is important. And I think that's also the reason why I think this is such an early space because, clearly, I generally feel that we're still, in the early days.
Sorry, Eugene. I think we lost your audio for the last
Oh,
10 seconds.
apologies. Yeah, I think I was muted. I'm just saying that when it comes to marrying new technologies, like whether is it smart contracts or whether is it, tokenized vault, and you're trying to marry that with traditional structures, a status quo, right? It's always going to be a lot of, back and forth, a lot of retweaking and a lot of, I guess, engineering and sort of work to be done. And so I think as the world becomes more comfortable, as regulators become more comfortable, I think we'll reach a stage where that easy access, that easy way of formulating tokenized products that's easily accessible and distribution, I think it's going to, bring a wave of new tokenized T-bills products or real world asset products. I think my vision is, don't be surprised, if BAMO or Goldman is going to launch a tokenized product or RWA, and I welcome that, right? I think the more the merrier, and I think you have different types of products, like Toyota today is building electric cars and Tesla is building electric cars. I believe in a world where you have different products built by different issuers for different sort of markets.
Yeah, and to a certain extent, I think we're already seeing the big boys come into the market. I think Franklin Templeton probably the biggest ones who've issued a whole bunch of tokenized securities on chain. I think coming back to sort of structuring products and stuff like that. Come to you, Sid. I think Maple Finance V2 was launched last quarter. You guys are giving people more flexibility for both lenders and borrowers, and more flexible lending terms. I think talk to us about a bit about that. Who is this targeted for? Who do you see use more of this flexibility?
It's a good question. So I'd say when we released V2 of Maple, we wanted to introduce more flexibility in how liquidity and redemptions worked. I think in the very first version of the protocol, you could have this issue where people would try and front run each other if they wanted to redeem from a pool, and I think that was problematic. So what we did was we just shifted it to epochs. So you basically, like, you're all treated the same if you want to withdraw in the same epoch, and you get a pro rata share. So nobody gets a preference over another person. And then the other thing was introducing more flexibility for how you manage the loans, whether you want to impair a loan if you think a borrower is underperforming, which again just helps ensure fair treatment of the lenders in the pool. More recently, though, what we've actually done on Maple is introduce Maple Direct, where we have a team that has started doing the underwriting themselves, and that was for us, and we figured it was a natural adjacency. We're already doing the tech. We're already super familiar with the space, and we have folks on the team who come from private credit fund, or banking and finance backgrounds, who are used to doing this. And what we wanted to do was fill the gap left by CeFi last year, where we think when it comes to private credit and lending, you want to be able to see the performance of loans in real time on chain. I think there are still some CeFi lenders who are kind of zombies at the moment, where nobody knows if they are still operating or if they have a loan book that is performing. And so I think it really highlights the importance of doing this on chain, where you just have instant, real-time, transparent performance. The other aspect is how you minimize counterparty risk. So being able to either hold collateral in a smart contract. In our case, what we did was we tried to evolve on what we felt were the shortcomings of CeFi by also introducing a qualified custodian. So we can hold collateral on chain in a smart contract, and we can hold it with a qualified custodian, and we don't rehypothecate it. So I think the proliferation of rehypothecation was really dangerous. Rehypothecating assets 4 or 5 times, and then the lack of transparency on loan book performance, which of course no CeFi lender wanted to say how their loan book was performing, because they were afraid they would trigger a bank run. So when you have it on chain, it just removes that kind of moral hazard or an incentive to kind of hide performance. Who I think we're targeting now is we're seeing more folks come in who are maybe a yield fund or a hedge fund who have a mandate to get yield on chain. We're also seeing a lot of interest from asset managers who are managing assets for foundations. So if you're a layer 1 or layer 2 foundation, you have to be relatively conservative. And so they're looking for, 7, 8, 9, 10% yields, but pretty good asset protection. And so that's kind of what we've tried to cater to here is the set of on-chain asset managers, also high net worth investors. So I think the space has still got a bit more to evolve before retail is fully into this type of thing, but we're taking steps in the right direction.
Yeah, I think you mentioned qualified custodians, so I think it's also a good time to talk about those, right? So with RWAs, it's inevitable you're gonna interact with custodians, lawyers, brokers, settlement systems, etc. Right? So there's a whole TradFi infrastructure that sort of comes into play. Open question for all of you guys. Has it been a challenge? Do you find yourself having to explain yourself again a lot? Is there a lot of skepticism? Are there people who are now trying to cater to crypto and to Web3, I guess?
Yeah, maybe I can give this a shot. I guess you know, we've been building OpenEden for like I think more than a year, and I can tell you that it's trying to work with Web2 TradFi institutions. There's a lot of education. You could have explained to them, oh, how do you exactly um, you know, um, you know, engage in KYC AML. How do you scan a wallet? How do you use the smart contracts? Is smart contract actually smart, right? So there's a lot of education, and I think there's also increasingly there was a time, I think, especially the last 6 months, where there's also quite a bit of resistance, at least in our opinion, especially in the wake of some of the big blow ups and implosion. I think it's been challenging for onboarding and getting some of these TradFi institutions comfortable. But at least from my experience, the barriers of entry of working with this off-chain, whether it's brokers, custodians, fund administrator, banks, I think it's becoming slightly better. I think they're starting to understand, the value proposition. A lot of this, TradFi, whether it's a qualified custodian or a bank, a lot of them, I guess, when we speak to them, I think some of them would actually have the aspiration to build a tokenized credit fund, a tokenized T-bill fund. And so I think a lot of them actually, interested in working with us to effectively understand if this is a business where they might actually get themselves into or involved at some stage. So I think it's becoming a lot better actually in terms of the sentiments when it comes to working with off-chain service providers. Having said that, with the emergence of new technology, whether it's ZK Sync, whether it's using soul-bound tokens, NFTs, there's still an there's always going to be an element of education, an element of discovery and try and error, if I may, when it comes to working with off-chain providers. But look, I think it's a matter of time where we all get on the same page. Like clearly, the accounting standards are not gold class and standard from day one. We're gonna get there somehow. So hence, I still think we're very nascent and early in this RWA space.
Yeah, and Cassidy and Sid. I think Cassidy, you mentioned working with lawyers. I think earlier in the call. Yeah.
Yeah, I mean, that's definitely where we spent the most amount of time, is educating, regulators as well as like other legal teams that are out there. And I think, yeah, crypto as a whole definitely spends a lot of time with regulators at the moment. I'd say it really comes down to with the case of a lot of these like service providers in the traditional sense, they're evaluating the risk that's there, working with crypto protocols versus the opportunity that they have. Oftentimes there's no extra opportunity for them, based on, their business models. They're pretty much doing the exact same thing for us, but they see us as having higher risk. And ultimately, as Eugene mentioned, a lot of that is just education and trying to help them understand how these protocols work, how they can actually work within the system in a way that it isn't taking more risk on their side, but it really is, I think, just a lot of time that we have to spend with them and educate them, of what these risks really are and how to mitigate them, to be able to really work together better in the future. I think, I mean, Sid, you also mentioned a lot of these traditional service providers will probably become obsolete as well. We'll probably get rid of the need for some of these things, going forward. But I think, that's maybe even a longer time away, because we do still have to develop quite a bit, I think, within our crypto protocols. There's still a lot to build, but I think we are getting there.
Sid,
I think
anything
with
to add? Yeah.
I think with I mean, we do have to spend a lot of time worrying about regulation, which is problematic because it's like a huge what do you call it? Like in economic theory, there's this concept of like dead weight economic loss, and let's call it that. which is time wasted that is not leading to productive output or a better product. So if you look at the main fundamental purpose of regulation, right? It's to increase lift the base standard of product or service that is out there, and then reduce variance. So you want to go to if you want to go to restaurants in a city, you don't want to get food poisoning, and you don't want a really high degree of variance in the outcomes. And currently, I don't think regulation has unfortunately solved either of those problems in the crypto space. It hasn't increased the quality of base level service because it's not actually legalizing any services in crypto. So most folks are having to operate under a regulatory exemption, which means they're kind of de facto outside the purview of regulation because it hasn't said here's what we consider to be a good, solid crypto product that could be offered. So you just have to operate under exemptions, which I think is problematic. It then means that lawyers are taking radically different interpretations. So if you go to 10 different lawyers, you get 10 different opinions as to whether something is even legal or not, or how you could approach something. And I think that's ultimately leading to costs that get kind of passed on to consumers or slowing the pace of innovation. But I think I'm actually ultimately probably most confident in the US's ability to eventually get it right. I think other jurisdictions that might maybe go a little bit too quick, too hard, are going to perhaps create something it's more of a straitjacket than a sort of comfortable regulatory environment. And I think within the US at the moment, you kind of have a bit of a rogue executive, but like relatively protective judicial segment, and then also the legislative branch is also trying to put in place like market structure bills, which I think is positive for the sector. And I think lobbying has certainly picked up as well. I think Coinbase has done a really good job there, albeit they certainly have some friction with regulators at the moment. Anyway, that was kind of long-winded, but all it is to say, like, I think it's kind of moving. There's definitely a cost to the way that the regulatory environment is set up at the moment, which is ultimately being either borne by investors who are participating or consumers who are using this but paying higher prices for products because they're ultimately footing the bill for legal.
Yeah, I think regulations probably still have a long way to go, and they probably still have a long way to understand. But I think interesting take from you, Sid. I think this is the first time I've heard people optimistic about US regulations for a while now. I think the mood, or at least from outside looking in, I mean, we're based in Asia.
Well, yeah, I mean,
It's
you have a transition in the next 2 years of the head of the primary US regulator, and so I think it's only really that executive branch that has been missing in regulation at the moment in terms of like proper regulation.
Yeah, and I do want to make a slight comment on this topic. I think it's hugely understated the amount of work that whether you're doing, I think, credit or publicly listed securities. I think with respect to RWAs in general, I think there is a lot of work when it comes to legal and compliance that is taken for granted. I guess there is so much work, like for example in OpenEden's case, we have like 5 different legal counsel. We just hired the head of legal from Sydenham Bank. I mean, we have so much legal and compliance that is very unheard of for any startup company. But that's really the rules of the game when you want to go to RWA, especially in a listed space. There's just a lot of regulatory compliance and legal conformity that you just have to adhere to. And I think that's the challenge in building in this space. And I think it's something that it's tough, but it's what we just got to get going.
Yeah, I think those challenges still need to be worked through, but ultimately, I think if you want to sort of operate legally, I guess, or as regulatory compliant as possible, it's the hard work that needs to be put in. I think wanted to come back closer onto chain. I do know that we have a long list of questions, but we sort of always run out of time. People have started experimenting. I think Eugene mentioned layer twos earlier, but people have started experimenting on deploying RWAs on different chains. Some of the bigger boys, I think Goldman and JP Morgan have got their own private chains going as well. I know Cassidy, Centrifuge also have gone on to layer twos. I wonder if you guys worry about liquidity fragmentation, right? As it is, people always say, you know, there's too many chains, liquidity is everywhere, and you know, maybe it's more an art than science, that you know you sort of pick the right layer 2 or pick the right chain, and then sort of it's and sort of you pick the right one, and that's where liquidity ends up finally. I'm just wondering, how do you guys, you know, sort of think about this, about multi-chain deployments and things like that? Maybe Cassidy can start, since you know Centrifuge went to a few layer 2s already.
Yeah, sure. So actually, this was a huge part of what we thought about when we were designing how to actually coordinate these launches. The way that we ultimately built it is hopefully not fragmenting liquidity by really just tying liquidity from these layer 2s or from these other chains to the assets that are living on the centrifuge chain. And basically, by having the product split in these ways of being able to have a purpose-built chain just for the assets, and the securitization engine is, if you will, of how we call it, basically taking care of all of that heavy logic that can't exist on a layer 1 because it's just too expensive to actually make it competitive to TradFi. That's what we focused on, as having purpose built on this chain, and then being able to have that access liquidity on any other chain that it exists. I think what's important there is, yeah, that you're really accessing that liquidity, that liquidity is able to access the assets. So being able to have that flow both ways, but not taking the liquidity away from those layer 2s, right? So I think really importantly, you should not be able to, or you should not really focus, I think, as a protocol on deploying new instances on each individual chain. I mean, one, that's just extra work to just relaunch your product on every chain out there. I mean, you could, but I think it really gets into that territory of what you just mentioned, of really segregating your liquidity as a protocol. And I think ultimately that's not where we should try to get to with crypto. We should really be focused on, I think, a multi-chain future that does involve that we are improving the bridges that we have. But I think we are getting there. I think it was very unfortunate, the hacks that we saw of the bridges that existed out there, but I think they're getting much better. And we do have other options, such as USDC's, protocol that they've built, which I do think has less risk. Unfortunately, it does have more centralization. But I think, we're going in this direction of having better bridges, having more chains that I think are interesting, do have liquidity there. So we do want to actually be able to access all of those different chains without taking that extra, work on of just relaunching an entire protocol on every single chain out there. So yeah, I think definitely it's about balancing those two things. But I think, we're starting to go in that direction. And I think, probably, and Maple is already on Solana. I think we'll start to see more and more protocols interested in launching in more places, and ideally focus more on pooling liquidity to access these assets.
Yes, Sid, why don't you go next? Talk to us about Solana, and you guys recently went back, I guess.
Yeah, I mean, we had launched on Solana in 2022. We'd already kind of built the protocol, and then we kind of paused it or furloughed it when TVL dropped significantly, and it was clear we weren't going to be able to manage a pools of the size that we wanted to on there. And since we launched cash management, we've seen a lot of demand. We saw a lot of inbound demand to go and put that back on Solana. So we've done that. We saw 4 million in deposits in the first week, which was pretty good. I actually like having a kind of hedge. So I think you have the sharded, call it the sharded paradigm from Ethereum with the L2s, and then you also probably have a monolithic structure going in parallel. And so it's nice to have a dog in that fight with our Solana version of the protocol. So I think it's kind of healthy for diversification for us to do that. I do think, you'll probably see a lot of like high frequency trading and activity that requires like more parallel processing happening on those monolithic chains. So I think we're excited about being on Solana. I think the community's been really resilient. So I'm happy that we got that relaunched. We're also looking at the L2 stack though as well. So we're currently looking at deploying an L2 of Maple, because our view is that when the next bull market comes back, gas costs will be super prohibitive on the L1 version of the protocol. And so we've just got to do something to alleviate that. I look at, in terms of where I look at either strategic partnerships. So you can look at something like Base, or you can look at where a lot of the activity is. And I think, the DeFi ecosystem on Arbitrum is really impressive there as well. A lot of the challenges that you face, and particularly as Cassie alluded to, there's a non-trivial amount of resources in supporting an L2, and so you're looking for ROI in the form of liquidity on the chain. And I think one of the problems that a lot of L2 teams haven't solved or aren't thinking about correctly is how they will get liquidity on the chain. And a lot of them are kind of misunderstanding fund returns and thinking that like a market maker is going to just deploy funds into a compound fork for a 3% return. And it's like, the answer is they're not, unless they see a path to getting 15, 20% return from the native token of the L2. And if you have a whole bunch of native tokens coming to market at the same time, I actually don't think that there's the retail demand for market cap to support, valuations in the hundreds of millions of dollars or billions for a lot of these L2s. So I think there's going to be some value destruction there. And that's why we're kind of, we're not racing onto every different L2. The answer, in my view, is to look at how you can get on there in a very low cost way by not necessarily porting your entire contracts there, but just having like a hub and spoke model of access points onto L2s. That's why I think like Layer 0, Axelar, Stargate, like a lot of these other tools are really interesting from that perspective.
Eugene, anything to add to that?
Yeah, I think it's I think with the emergence of cross chain and bridging, better tested bridges, it's not necessary to be on every L2 L1. I think it's you just got to pick your your niche and your audience. And I think at the end of the day, like when I choose to buy a phone, I don't really, like for me, for example, I think most people wouldn't care about, like, oh, the Samsung phone has a better processing speed and whatnot. I think that a large part of that decision to go into a new L1 or L2 is going to hinge on, I think, TVL distribution, the sort of product market fit of your product and the audience. I think those are the more important questions that I think is going to hinge on a lot of issuers like us. So yeah, that's really my viewpoint.
Yeah, I think that the other part about coming on chain obviously is composability, right? And that's one of the big promises of DeFi. You become a primitive and you allow other people to build on top of your product. I'm just wondering, it's still a relatively nascent space, but do you see that start to happen with your protocols? Are people starting to take what you have and start using it as a Lego piece for something bigger? Yeah, I open question to you guys.
Yeah, maybe I can start. Yeah, we do, while we are a permission product, clearly as an issuer, we have to be really focused on issuing. And we do obviously KYC, our investors are typically accredited investors. But having said that, we do, have one, I think, other devs, wanting to build on T-bill tokens. I think in the next couple of weeks, there will be, a variety of, protocols building on T-bill tokens. And I think that's going to be interesting. I think that's one, benefit of using tokenized real world assets versus, buying T-bills in a brokerage account, because you can get better financing rates from another brokerage if it's tokenized, and you can do a lot more cool stuff. So I think that's really truly one benefit, I think, and that's going to be really interesting. Yeah.
Yeah, Sid or Cassidy, anything to add to that?
I can jump in. So the question was around like KYC and
No.
composability.
yeah, composability, and well, tangentially KYC as well, because most of everyone's product is sort of permission in that way.
Yeah. I think the space has definitely trended in the direction of permissioning, because we wanted to court, particularly if you're trying to court partnerships off chain like brokerages and custodians, then they need to be able to rely on kind of KYC. But if I think you'll actually have composability in both directions. So composability with CeFi and eventually TradFi, and also composability within DeFi, which is more it's kind of tough when it's too permissioned. I think you've seen folks increasingly try to tread a middle ground where you might have permission minting and redemption, like for tokenized T-bills, for example, and then permissionless secondary trading, like I think Mountain Protocol, Ondo recently moved more in that direction as well. Bloom and some of these other protocols which are trying to like lean into the permissionless composability, which I think is important. I actually would like to see it go more in that direction. Albeit there's a risk you're underwriting there, which is kind of like I call it like a regulatory put that you're short on for your whole protocol if it goes against you. For composability with CeFi, I think increasingly we're seeing folks like custodians, prime brokers looking to hold some of this stuff as collateral, which I think is super interesting. Like if you're a trading firm and you're trading through a permissioned walled garden or a custodian, probably better if you can hold tokenized T-bills that earn you a 5% yield than just holding dead stable coins as collateral that aren't kind of offsetting your cost of margining and borrowing on those platforms. So we're having a lot of interesting conversations in that direction. I think that really showcases the advantage of the composability. So I hope we don't trend too far towards rigidity and requiring absolutely every transfer of these assets to be permissioned or every interaction with the protocol to be permissioned, because I think we'll miss out on a lot of the innovation that we can have from permissionless protocols. So yeah, I guess I would say I think permissioning is probably going to be the standard for dealing with a lot of institutions, but we need to have some ability to have permissionless composability on the back end.
I'd say generally agree with Sid there that ideally we have a mixture of both, of some products in this area that are permissionless and remain permissionless, and then some products, generally the ones that probably touch more of traditional institutions, will need to be permissioned. But I actually would add, I don't think this really needs to hurt composability, because we can actually see, and we are seeing actually more and more protocols that are going in this direction of being decentralized, but also being permissioned. And so one example of that is this new DEX that just launched. That's a permissioned DEX that's called MOV, that we're at Centrifuge hoping to integrate with. And I think it actually makes sense for a lot of real-world asset protocols to look in this direction of how do we maintain this decentralization, being able to use these tools that we've created that are open access in some level, and removing intermediaries as well, I think is important there, and still be able to have some amount of permissioning, in this case just KYC, access to this KYC information in the case that a regulator would actually need to be able to show to be able to see that. So I think it's really about finding a balance in this medium term, I would say, where we're trying to work with regulators and be able to build products that are sort of bridging both this DeFi and this TradFi side. But ultimately, I guess long term, we're hoping to be able to build products that can be permissionless in more ways. And I think we're getting there. Maybe it'll be a hard journey there, but I think, yeah, for the midterm, really finding that balance and building protocols that are able to do both decentralization, open access, and be able to appease regulators. And then long term, as crypto, building towards that permissionless future.
Yeah. It's almost up to the hour, and we barely got through a lot of the questions. There's just so much to talk about in terms of RWA, but I think we've sort of got to wrap up now. I just have two questions for all of you before we wrap up. I think give us your thoughts about, what do you think is required for RWA to continue to grow as a sector. I think, we talked about some of the challenges, so maybe there are some solutions that are there or being worked on, and also tell us more about what we can expect from your respective projects moving forward. I think those are also exciting for our listeners. That's always the next thing that's sort of coming. And yeah, we'll just go around the table. Yeah, maybe Sid can go first.
Yeah, I can go first. So I mean, from our side, I'm looking kind of two fronts. I'm looking at integrations for like cash management pools. So I think that's going to be super important. I would love to see that integrated as collateral so that firms can use it when trading. And the second thing is just getting some more diversity in the real world asset pools that we have on the platform. We are seeing more interest from kind of funds and high net worths in those products. So I want to put out a pool and really showcase the innovation and how much better this stuff is for things like trade finance than what's happening in traditional banking. I think what we've seen in traditional finance is that most commercial lending is moving away from banks towards credit funds. And I just viewed what we're doing as, OpenEden, Centrifuge, Maple included, as kind of the next tech platform or paradigm for private credit and credit funds. And so I think we just have to get more assets on chain. So next RWA pool is what I'm most excited about.
Cassidy?
I think in the near term, really building towards these crypto native users, DAOs, other high net worths, foundations, anyone who has their liquidity on chain. I think that's really in terms of building out our products to actually be useful enough to them, provide them access to these assets, but also really building out, the other side of being able to issue these assets, creating a product that's actually really improving on what this looks like within TradFi, removing those intermediaries, building products that really work and aren't prohibitively expensive. I think in the near term, really focusing on building products for those users that are on chain already is what's going to get us there. And then hopefully, once we actually get to a place where our products are in that next level, next version, and we have all of these on-chain users, hopefully the market returns and we have institutions that are much more interested in going into crypto again. And you'll see another big spike in interest in real world assets, I think, then. So I think, we're all really focused on how do we grow in the short term, grow our products, get to a place where we're really providing something that's orders of magnitude better than what's out there in TradFi. And we're definitely not there yet. I'd say it's really about getting our products to a level enough that they're really competitive in that way. And then being able to go out to traditional users, traditional large institutions like pension funds, like you mentioned, and be able to say we actually have a product that makes much more sense for you now.
Yeah, and thanks so much for that. And Eugene?
Yeah, I think for us to move forward, I think regulations have to clarify their stance, especially with tokenization. I think that's one. So I think when with over time, I think especially in Asia, I think we're starting to see some clarity in Middle East, in Dubai. I'm sure it's also quite evident that there is a lot of progress out there. So I think around the world there will be increase in clarity, and then that's going to help drive the next wave of adoption, the next billion or next 5 billion, 10 billion of assets on chain. The second thing I think is the maturity of the infrastructure. Like for us, in OpenEden, we've been on pause to improve our contracts. We're not undergoing audit. We're just trying to improve the pricing integrity, the oversight, all these different stuff that like Cassidy has mentioned, that we're trying to build a competitive product, build a product that we can actually win market share, replace some of the current incumbents right in the value chain today. And I think with blockchain and with what we're building today, we are effectively, trying to build a more efficient product that the future of finance is built for, right? And I think the one thing that we're also very excited, it's really to build a really trustless architecture that really helps the transparency and the regulations around. Oh, like the whole point about regulations is to ensure that consumers are protected. But if you have transparency, like real-time transparency on the underlying assets off chain, is there really an added benefit of having all these regulations, right? If you create a trustless architecture. So yeah, there's going to be a lot of I guess improvement and the maturity of this infrastructure that's going to help the adoption of crypto and real world assets eventually.
Okay, and that's all the time that we have today. We overran slightly, but it's been a great conversation. I think, like I said, there was so much more that we could have talked about. But thank you so much. I think Sid, Eugene, Cassidy for joining us today. I learned so much from the conversation. I'm sure our listeners did as well. Take care, everybody. It's been great, and join us for our next meetup on next month as well. So thanks, everybody.
Thanks, guys. Really enjoyed it. Thank you.
Thank you for inviting us. Thank you.